Hi. Thanks everyone for tuning in. As a quick introduction, I'm Jai Sumer Singh and I'll be moderating this panel. I lead the investments team at SGN, an early stage VC fund backed by the Sectoral group, and also volunteer at Knowledge Capital. This session will unpack Karthik and Manu's journey from angels to institutional investors. Awesome. So to show how excited you truly are, feel free to go berserk with the emojis and give a very, very warm welcome to both Karthik and Manu. Great, the emojis are already flowing in. So before we begin, a quick round of introductions. Karthik's the founder and managing partner of Blume Ventures, one of India's most well-known homegrown funds. Karthik started his journey as an angel back in 2009 before launching Blume in 2011. Blume is now onto their third fund, where Karthik has backed marquee companies like Unacademy, Grey Orange, Purple, among many others. Thanks a lot for joining us, Karthik.
Well, thanks for having me, Jay. Hi, for having me.
Our second speaker today is Manu Chandra, the founder and managing partner at Sauce, an early stage VC fund that focuses on consumer brands across categories. I was telling Manu backstage that Sauce is hands down the coolest name for a consumer fund. Manu is a private equity veteran. He was a director at 3i Group prior to starting Sauce. His investments include Drums Food, most widely known for their brands Epigamia and Hokey Pokey. He's also an investor in XYXX and The Whole Truth, among many others. It's an absolute pleasure to be hosting the both of you.
Thank you, Jay. Thank you so much. Thanks, big thanks to the Investments Decoded team for having me.
So, quickly setting the context, the last panel was on syndicates and angel funds. And for this panel, we'll be moving to the next step, which is institutional investing. So, very quickly, Karthik, starting off with you, what was your motivation behind launching Blume? And what was the trigger that made you take that leap of faith?
So I think for those who don't know our history fully, we started, both Sanjay and me were part of Mumbai Angels. We were early cohorts of Mumbai Angels back when they were just, you could count off the number of angel groups in this country on one hand. And ironically, I'm not a rich guy. It's not my family office. I was just dabbling with my savings as an employee. I was actually a Times Group employee until 2010. And I actually joined both angel groups as their corporate representative. But what fascinated me about tech and early stage investing was my 7 years in the US, having gone from MBA to the Valley to East Coast. And then the inability to break through to that sort of pushed me back to India, saying I need to start somewhere. Let me go learn the ropes and get going. So the need to institutionalize came from having tested these waters out as an angel investor with the corporate hat, which I was wearing at Times Group, and saying if I love doing this moonlighting over the weekends, because they wouldn't give me a budget to actually start cutting checks. It changed after Satyam took over Times Internet, but by then I had said bye-bye to the Times Group and took whatever little savings I had dabbling in angel investing and said, what if I actually could do this full time, right, 5 days a week, as opposed to moonlighting over weekends. And I found myself leading a lot of the angel syndicates inside of Mumbai Angels. In fact, represented them on multiple boards for good 4 or 5 years after starting Blume as well. And I said, if I can do this, in 4 or 5 companies moonlighting, then I can do 15, 20 a year. But the only way that would work is if you start putting an institutional framework around it, not simply doing it like a mom and pop operation. So from day one, we've been like a SEBI approved, we were the last fund done under the BVCF regime before we cut over to the AIF regime in its entirety. So we started in 11. By the time the regime change happened in 12, we had closed a 100 crore fund. But the way we operated was no different from how most of you are super angel funds or angel funds are operating. In fact, our model was to look on the West Coast and see how they were doing things. And with 60, 70 checks in the first 4 years, people thought we were crazy. But basically now it's very normal. There are 50 people doing it and nobody questions them. When we started it, people thought that we were super crazy. And so I think the penny drop happened much later, middle of the decade. So I think you had a choice. You either became like a Better Capital. What Better Capital is today is like a Blume Fund 1. You either continue in that avatar and stay like a cute 3-4% shop, or you institutionalize and start helping your companies at later stages. And today we've raised opportunity funds, secondary funds. We've played an academy at $1 billion valuation. We played Purple at a $300 million valuation. How do we do it and why do we do it? Because we want to stay vested in that journey for much longer, not just take our gains and get out. So that's a DNA shift. I don't think that's for every angel investor. I don't think it's for everyone. But I'll be surprised if amongst your audience, if there are 100 people, 2 or 3 don't take that path 5 years from now. So that's exactly what happened in the first angel wave. So Rehan, Sasha, me, Sunil Goyal of Your Honest, we all came from those 2 networks, right? And so it spawns, it's a funnel in my view. Somebody says, I'd love doing this all year and I want to help these companies for very long. And that's what I think that's the institutionalization coin that drops.
Yeah, it's like a gateway, right, into institutionalization, I believe. So while Blume was sector agnostic, I believe you were state specific, whereas Manu, your strategy with Sauce was different. You took a sectoral bet on consumer. Would love to understand your motivation and your trigger, and why only consumer. I'm sure you people would have asked you this a lot, but I mean, just for the benefit of the audience, if you could just sort of.
Yeah, sure. Thanks, Jay. Karthik, great hearing about your journey. Mine was a bit different. I started actually in late stage investing, so what we typically call private equity, and we were investing heavily in industrials and infrastructure. And mind you, that stuff is extremely boring, and your ability to influence outcomes there is very minimal, right? At the same time, and this was around 2013, one was looking at a massive uptick in the consumption economy in India. And fundamentally, I believe that consumption is going to be sort of the bedrock of the Indian economy for at least for the next 15, 20 years. So one was looking at opportunities in consumer, but in my day job, I was really looking at the other end of the more boring stuff. And my journey actually started more by serendipity. So Rohan, who's the founder of Epigamia, actually just lives down the road. And and one night he just walked in with 4 tubs of hokey pokey ice cream and a bottle of whiskey. And we sat in my small sort of 10 square foot balcony and we drank through the night, and he sold me the hokey pokey story. And he's at the end of it, he said, I'm doing a seed round of 25 lakhs. Do you want to put 25 lakhs? I said, I have no clue whatsoever on what angel investing is. I have no clue on what startups are. I don't mind putting out 25 lakhs, but help me learn what you're doing. So make me a franchisee. Let me run some ice cream parlors for you. Let me understand the dhanda. So that's how it actually started. I ran 2 outlets for a year. After a year, he came and said, "I'm raising a 1.5 crore seed round. Do you want to put 25 lakhs now that you know me well enough?" And I said, "Okay, now I'll put the entire 1.5 crores, but get me involved in the running of the company." And that's how the journey for Sauce really started. I mean, when I got involved in the day to day, I realized how screwed early stage founders are. They don't have access to resources. They can't afford talent. They're not even thinking strategically. They're just basically firefighting every day. So that's when we thought, let's try and make this bigger. I was contributing towards Epigamia. I said, how can I institutionalize this? How can I take the help that I'm providing to these founders in a larger way? So Sauce was born effectively to look at consumer brand opportunities as a very small provider of capital. We're not a big fund. We're never seeing ourselves progress to going beyond a first check or a seed fund. But what we do is we provide a lot of value by having a very strong focus on just one sector, and then bringing in sector experts and partners to help in various aspects of building the brand. So whether it's performance marketing, whether it's packaging, shelf stability, all of those good things that these founders need, we can provide help in. And our fund thesis is slightly different from a classic tech VC play. We do very few deals. For me, the success in Epigamia was I had skin in the game. I had a decent stake, and it turned out to be a great outcome for me. And we're trying to replicate a similar model within Sauce, because in consumer brands, it's not a winner take all. You don't need a sudden escape velocity or network effects. In every category, many brands can coexist. So you can actually build these businesses ground up with these founders and deliver reasonable outcomes for yourself, provided you have a reasonable chunk. So in fund one, it was a really small. It was a really small fund. We raised 60 crores and we did 9 deals. We're now sort of kicking off fund two, which will be slightly larger, but we'll again do 9 to 10 deals. And that's been sort of our journey thus far. So and why consumer brands is largely because I believe the opportunity is really big, and I think with digitization, that opportunity just gets amplified. And for me, it's a conscious call to sort of just have a small niche and focus play, and become better as we go on that specific product. So hopefully we can add that much more value to our founders and therefore to our LPs.
Right, got it. I think the key takeaway for me is that a tub of ice cream and a bottle of whiskey works better than a slide deck.
Great. A bottle of whiskey is always a great way to start things.
Certainly. So shifting gears a bit to understand how you individually, both of you, looked at the risk of managing external capital. Karthik, starting with you, you've now seen multiple cycles over the last 10 to 12 years. How did you evaluate the risk reward when you decided to shift from investing your own capital to managing external capital? And now, with the benefit of hindsight, how has this actually played out for you?
I think the motivation eventually becomes, I mean, as I said, I've not made riches yet, right? Last month was my first ever carry check in 10 years. Takes a long time to see money in this business. And so I think for me, it was more like this was a necessity. It was not an option. If you wanted to do what you love to do and you wanted to do it in spades, you had to put your hands out there and get other people to finance you, just like any other startup entrepreneur, right? It's like asking people, would you bootstrap or just go and get community financing and build quietly and build a lifestyle business, or do you want to go all out and raise venture capital and grow because you see the opportunity? So I think the size of the opportunity, and kudos to Manu and a lot of other funds in the middle of the decade who came in, wanted to start small, establish credentials, stick to what they like. I think foolishly or otherwise, my ambition was to try and play in every area, right? Today, we know it's not scalable. So I can't do every sector. I can't compete with Manu if I want to do consumer brands, right? So what we do is inside the team, you specialize, but even to be able to satisfy each of your partners, so to speak, what eventually you'll end up building if you build an institution is it's a partnership. And every partner has got to feel like this is worth my lifetime. Because this is not a short-term business. We essentially are building this for 20 years, 25 years. So when you add the weight of that to your own head, then it's, of course, you might be one of the founders, but it doesn't matter. It won't survive beyond 10 years unless you build a partnership. And then each partner has a similar ambition to say that I want to do, deep tech investing for the next 10 years. And that is 3 cycles of $20, $30 million each. So there's no escaping that. So of course they can go and do it on their own, which a lot of people did. I know half the ecosystem is people who came to me and said, are you looking for a partner? From 2012 all the way to 2018. Now they don't ask, I guess, because we're already full up. But I said, look, I can't support that ambition. And so a lot of people went and started on their own, right? And so to the extent that we could, we said, we'd love to do 10, 15 investments a year. It was 20 investments, then came to 15, now it's 10. And we can support a partnership of 5 people. So the only way you do that is to get rapidly institutionalized. And HNI family office money only goes that far, right? We haven't seen those cycles of success in India that you can raise money only from them. Plus, you want deep-pocketed capital to come and back you, not one cycle and then question you 3 years down the line. I have nothing to show 3 years down the line, other than a few cute Series A and B markups, right? The real rubber hits the road after 10 years, 7 years, 8 years. You need believers who can buy that story. But it's not easy to get them. So it's been a steady climb towards saying, and this is, I'm trying to practice what I preach. So I tell entrepreneurs that they should outlast investors, not the other way around, right? And their company should outlast them. And so fundamentally, if I'm preaching that to them, then I should be preaching that to myself as well. So institutionalization is a choice that you make as an entrepreneur, if you ask me, that whether you can build a long-lasting firm which similar to the great public companies in the US in tech. How did they get built? Not because somebody said I want to get an M&A exit and get out after 5 years or 7 years. So it's the same idea, I think. And when you go down that path, then it's a one-way path. You can't reverse that thinking process because the ambitions grow. And as I said, now we've gone from 2018, same month, if you'd asked me, we were 85 million under management. Now we're 305 million under management. So, it's a heavy burden to carry, by the way. You have to return, 4 to 5x of that 200 additional million. but
Right.
basically, every time you put a pitch deck, as I joke to my colleagues, every time you put a pitch deck and put a mugshot on that, you've signed off 12 years of your life. So
Right.
you got to make that commitment that you got to have fiduciary responsibility over that capital for 10, 12 years. Otherwise, you step back and say, remove me from this slide deck. And that's why partners retire at some point. It gets tiring. You run 4, 5 cycles and you say, I'm done.
Right.
4, 5 cycles is 15 years of fundraising and deploying. It's about 22 years before you exit.
Yeah.
It's a long time.
Yeah, I think a long time and a lot of flights, I think.
Yeah.
But Manu, I'd love to get your take on this, especially given your private equity background, where at least in infrastructure private equity, the focus is more on downside protection versus upside maximization relative to VC. How did you think about risk when you sort of made the plunge from as an angel to an institutional? I think we lost one.
Sorry, I think. Am I audible now?
Yes.
Yeah. So, sorry, I tech issues, but so my journey, I mean, and my perspective is very similar to Karthik's. I think we are in some form of fashion a similar scale and trying to test a hypothesis on a different product where they were with Blume One, right? When they started Blume One, they were literally trying to figure out, does this even work, right? For me, taking a consumer brands focused seed play with a lot of value add and a focus sort of few number of deals kind of approach is not something which is common in the market. So the way we started Fund One was, look, we said we'll raise 60 crores. And I said there's a heavy burden of taking external capital on something which is a hypothesis, right? So I put in a big chunk of that, right? So it was basically I had a reasonable exit from Epigamia. I took the profits from that and put in a sixth of the fund myself. And so the statement to my LPs was very clear, that I am fully aligned, right? I make money only if you make money. And if anyone loses money, I'm the first one. And obviously on 50 crores, the fees is not enough to, even feed I haven't drawn a salary for the last 2 years, for instance. So that was a commitment. But of course, we're still very early, right? The journey that Karthik's talking about has seen full cycles across multiple funds and exits. And congrats, Karthik, on getting your first carry check. I know, and it's a big deal. So we're still very early in that. And for me personally, by nature, I'm a slightly more conservative guy coming from late stage, right? So I'm still molding myself, if I can be honest, in terms of risk taking ability. And it's funny to hear that from an early stage seed stage investor, right? But we want to sort of take the growth for sauce in a different dimension, which is one is of course about the nature of scale and raising money from LPs and burden, having that burden. But also when you talk about building a franchise or an institution, you're also creating a brand, right? What we're trying to do right now is essentially focus on creating a brand for sauce where it is seen as a specialist, as a focus, and as a value adding partner, such that founders who are starting up in consumer brands, when they think of their first 2 crores or 3 crore check, we're in the top 2-3 names, because someone like Sauce can never compete with a Sequoia, or we just can't. It is very important for me therefore to create that niche, create that franchise, get access to hopefully the best founders, and then that's when I get the confidence that I can raise more capital from LPs and successfully deploy it. So we're still very early in that evolution, I would say, for Sauce.
Right. Yeah, I think that's a great point, which makes me more curious to dive deeper into how your individual approach changed as you moved from an angel to VC? And I know, Karthik, you brought this up earlier, where now it's a partnership and each partner looks at a particular sector and is committed to that sector with a team under that. But across all the elements of the investment value chain, starting from sourcing, ending with portfolio management, what changed for you from like angel to VC?
Huge shift, actually. And it keeps getting worse, the problem, in a good way. I mean it in all senses. But in jest, it is actually a terrible problem. Because that whim of actually cutting a check of 10, 20 lakhs, you can never exercise that, right? It's the most sort of distressing feeling at one level, because for 6, 7 years, that's all you did, right? You essentially went with your gut, your intuition, and said, good person, I want to back them, let me put some capital. And it's such a small percentage of the fund that, even if it doesn't play out, perhaps you'd be okay, right? As you institutionalize and raise larger funds, those outcomes are meaningless, right? You have to have a sizable outcome from every winner, and you can't have 3 different types of winners. So there's and I'll come to explaining that in a second. The second more important thing is that when we raised the 100 crore fund, the first one, if you got a 50 crore outcome and you own 12, 13%, 14%, even at a 50 crores, it actually 7, 8 crores is a movement of returns, right? You're trying, but put it in the context of the fact that you have to return 300, 400 crores, it's actually nothing. It's peanuts. But now I stretch that argument to 100 million, let's say, and you get a 600 crore outcome. And even if you own 6% after all the dilution, you make 36, 37 crores. You say, wow, I made 35 crores off, 1/3 of the fund is back, etc. Good excitement for a company that exited after 2 rounds of dilution before $100 million. Now I changed the 100 crore fund to 100 million. And for the same relative impact, both your stake has to be much higher and the outcome has got to be much higher. Right? The combination of stake into outcome has just expanded dramatically. So the idea that somebody tried really hard, pushed every boundary, got you some, an outcome which is fantastic, an acquisition of $75 million. Unfortunately, it doesn't even get mentioned in the top 5 of the outcomes that you're playing for. And it's tragic at one level because that entrepreneurship has actually taken a back seat in your front view mirror, right? You just leave it somewhere in the distant past in the rear view mirror, right? So, and then as you grow, therefore, and if you want to return $400 million on $100 million, and at exit, you, after dilution, you on average hold 8%, let's say, you have to create $5 billion of market cap. $5 billion on a $100 million fund, right? So when you put that in context, the entire lens changes. You asked me about, while we were sitting backstage before the panel started, you asked me about an academy. That is the kind of outcome that people will applaud. The other guy who's struggling at $50 million trying for a Series C, they'll say, we'll wait and watch. Let's see if it's actually a meaningful one. And he's one of your top 10, 12 right now. It doesn't even move the needle. So goes back to the power law of venture applies across the board, whether you're an angel investor or whether you're an institutional investor. But when you're playing with not $1 million of angel capital across 20 companies, but you're playing with $100 million across 20 companies, the outcome sizes that make a difference just change dramatically. And then the flip of that is you're not a 1% shareholder as an angel anymore. You're owning 10, 12, 14%. You're on the board. You have to add that value. So it's on your head. You can't say, the founder screwed up. No, you're part of the journey. You are truly a partner in that journey. So I think a lot of the weighting of how you evaluate changes dramatically. I'll stop there. You can go on for hours on this, but Manu should add.
Yeah. Manu, a specific question for you. You've been a private markets investor for most of your professional career. What were some of the things that you had to unlearn when moving from infrastructure, private equity to angel, and then angel to institutional investing?
Private equity to angel is, a different word. So pretty much had to learn or unlearn everything, and if you wear a private equity hat and try and do angel investing, you're basically going to go nowhere. I think for me, that recognition came pretty early, and which is why I undertook the whole journey of trying to sort of operate and help in operating the business alongside the founder to learn more about it. Because private equity investing is at a stage where most of the elements of the business have become fairly predictable. It's about financial engineering. It's about how you manage your balance sheet, how you manage the mix between debt and equity and all of that, and then taking those businesses to an IPO, right? The team is there, the management team is there, all of that. Angel investing is finding a founder working out of a garage. I mean, the first factory for Hokey Pokey actually was an asbestos sheet, set up with rats running on the floor. So it was that bad. But that of course is a sea change. But it's far more invigorating. I mean, it's far more energizing to work with young founders who are sort of spinning new ideas, who've got an entire vision to execute, which hasn't been done before by anyone. So it's definitely, you feed on that energy as an investor, and it's just extremely fulfilling. And Karthik also mentioned, how he's into this because he loves doing this. And for me, it was a clear change. The first bite that I got of early stage angel investing, I knew this is something I want to do for the rest of my life. And institutionalizing it is just formalizing it, and thinking slightly differently in terms of portfolio construction and all of that Karthik mentioned. And those are the things that you do differently as an institutional investor. But at the very core, you're basically putting your bets behind a founder with an idea, and trying your level best as a fund to help them succeed. That's it. It's that's what it comes down to.
Right, right. I think both of you, in a way, spoke about portfolio construction. Karthik, you mentioned that Blume was also, the first fund was positioned as a super angel fund where you invested in 70 plus companies. Why did you choose this as your strategy, and how did it, at the end of the day, influence your ability to add value to these individual portfolio companies where you had, let's say, 3 to 5%, 7 to 10% across the spectrum?
So clearly it was indexing or diversification. I'm not going to walk away from that. I thought it was a positive thing in the context of where the market was in 2011 to 14, right? So nobody knew whether deep tech or SaaS or consumer brands or which is going to take off, number one. And the universe of people who could cut a check after me was very, very limited. You could run through your two hands maybe a second time, and that was it, right? There were no foreign investors. There was no cross-border. There were no co-investors of our nature. So if you theoretically thought by concentrating the portfolio, your probability of the bet getting money was better, I don't think it was. So when that happens, you diversify. That's why you index. And that's why there are index funds and there are managed funds even in the public markets. So we chose the indexation route, for the lack of a better analogy, right? Counterintuitively, for the second part of your question, it's a 2014 article on Andreessen Horowitz in the New Yorker. So just Google New Yorker, Andreessen Horowitz. If you find a 2014 article, read that. And we discovered, without knowing it at that point of time, we were doing what Andreessen was doing, right? So Andreessen basically built a platform offering where the platform team is twice the size of the investment team. It's not new. It's been there since 2010, 11. They started in about 8, 9, right? And the way they got that platform team to start functioning in terms of economies of scale, they actually had a sub-strategy apart from their core strategy, which actually played seed checks and set 100 of them over a 3-year period. Because only when you have volume does a platform make sense. You got to have 6 companies and get the best resource for distribution to Nature's Basket, etc. So Manu, as much as he has relationships there, will struggle to find a full-time resource for that, right? For us, by 2013, we were hiring full-time resources who could actually, and we spun them out into sister concerns. We have an entity called Constellation. We have Passion Connect, which does hiring. So Passion Connect is 5 years old. How many people do you think they've placed into our portfolio? It's about 650 and counting. It's a machine. It started with one girl. It's now 15 people, right? So the platforms that we built could not have been possible if you were running mom and pop, like 5 companies, 6 companies, 7 companies across, 5 different sectors. So we are not sector specialists, but we are horizontal specialists in the way we add value, right? And that, I think, was something which is very unique to us. And that advantage, I don't think other people can replicate for various reasons. And so we're kind of proud of that. But if not for that crazy strategy, that wouldn't have actually emerged at all.
Right. Right. Actually, that's incredible insight, right? Because in a way, you manage to place a lot of bets to have a higher likelihood of finding an outlier, and then also, the economies of scale made sense to have a platform approach with Constellation, Blue, Passion Connect, and the other.
And last point on that, because it might be relevant for your angels who are listening in. It actually, think about it, we have 70 cap tables, right? At least in half of them we invested with actually angels or angel syndicates, right? By the end of 2014, I know exactly who I'm never going to invest with in my life again. And it gives you so many data points on founders, on co-investors, on investors who can come after you. So today, I mean, unashamedly, I will brag about this. I'm one of the best bankers at Series A, Series B in the country. I know every co-investor one stage after me, as well as any banker can. And that came from that powerhouse like portfolio construction, right?
Right.
So you know everybody. Like I'll tell you down to like which person in which firm, how they think.
Right.
Right? So you just get economies of scale out of it, and I think that's a secret sauce in venture actually, right?
Right.
How do you in a information asymmetry business? How do you
Yes.
magically have more information?
Right. I think that's one of the core edges in this business, having information asymmetry. But Manu, in terms of portfolio size, you're at the other end of the spectrum. You almost took a leaf out of the private equity playbook, where you're highly engaged in company building and have a concentrated portfolio of 8 to 10 companies. So, as Karthik mentioned, in a business where you need to have many bets to find an outlier, what were the reasons that you opted for a concentrated portfolio strategy?
Yeah, I think it's really a function of our sector, to be honest. We're not doing something. I mean, the bets that I'm taking right now are not new technology or unfounded or sort of absolutely you know new horizons being opened. What we're basically doing right now is we're investing in businesses which are basically taking on incumbents which have done absolutely no innovation for decades and have become multi-billion businesses only on the strength of distribution, right? So there is already a lot that we understand about these categories, right? Therefore, our ability, right, to have slightly more, I would say, educated views on outcomes exists. Right, I'm not doing deep tech, I'm not doing SaaS, etc. And if I was doing something so unknown, right, I would obviously be also sort of placing my bets in on a wider board. Here, the thesis is that in any consumer category, you can build a brand bottom up. None of the categories that I've invested in men's undies, I've invested in yogurts, I've invested in clean label snacking, luggage, those kind of things. We see a clear niche where these brands can emerge. We know what we need to do to help these businesses grow, and it's more important that we add that value, right? And for us, therefore, a more concentrated portfolio allows us to focus our bandwidth, right, as a fund on fewer companies and deliver a normal curve which is slightly flatter than what a tech VC funds would be, right? I'm never going to have 100x, right? But I'll have much fewer zeros as a portfolio, right? So
Right.
we will have a curve, but it's a much more flatter curve for us, and that's how it is playing out for us. And given we enter super early, and unlike tech, as I'm seeing it today, consumer is not so hot. It's never so hot, right? So I still get my 10 crore entry valuation, 12 crore entry valuation. And therefore, for me, as a small ticket provider, I have one eye on exits, right? Karthik mentioned about how do you deliver a 4x or a 5x on $100 million fund, right? It's relatively easier if you're small and an early stage player, because that much depth in the secondary market, even if I put $1 million and I take out a 5-6x, that much depth exists in the secondary market, right? Even family offices take us out, and that was the case for me with Epigamia, etc. So
Right.
we're playing it to our strengths in terms of where we want to exit and how we want to add value to the companies we invest in, and that allows us to build a smaller sort of portfolio.
Right. Right. Very, very interesting. Actually, the key takeaway for me here is that strategies can be different, and it's incredibly hard to return fund after fund, especially when the fund size increases. So I think really your strategy should be playing to the sector where you are and what your strength is. But one sort of last question to each of you before we move quickly to the audience Q&A. Manu, what would be your advice to angels who have just started their journey?
I think my advice is really at this stage, unless you're an expert in a sector, try and get access to deals with folks who know what they're doing. That's my simple. I mean, if you can tag along with a Blume in on one of the sectors that they're experts in, that's your best bet. If you can tag along with funds like us on consumer deals, that's a great bet to make. The second thing I would say is build your own personal brand as an angel investor, right? And that is determined by the behavior you display with your founders, right? If you cannot add value, please, for heaven's sake, don't be a pain in the ass. I mean, that's the least you need to do, because it is still a small community. And like Karthik knows all the angels and how they're going to behave, we also know specific angels who we want to work with or don't want to work with. So build that personal brand through the behavior that you display in your investments, and that's the best way to go. And start small, keep learning, and start increasing your exposure as you get better at it.
Awesome. Karthik, what would be your advice to angels who currently run their syndicates? Like, what can they do now that would help them when they and if they want to and decide to institutionalize?
So I think echo what Manu said. To add to that, I would say if you're leading a syndicate and you're the face of a syndicate and you're actually working with founders, then you need to be incredibly dedicated to making a difference to those founders. Otherwise, you don't want to be treated as dumb money if you're really a value-added angel. If you want to play, you have to make a decision whether this is a long-term, I love this space, I want to be working in early stage capital, or do I want to allocate capital? And please separate out the two, because they're not the same. Allocation is something that you would do as if you were allocating to a bunch of indexed funds on this public markets, right? And there, what you would do is to get into, bed with somebody who knows what they're doing, like Manu said, and simply watch whatever comes through the syndicate and allocate away. The only difference being you got to allocate like a SIP. Even angel investing and venture investing is like an SIP. You can't say, I know best, I know, that I will play 6 months and after that, बहुत हो गया, मैं बैठ जाऊंगा. कुछ नहीं होता है. 8 साल के बाद returns आते हैं, right? So basically, you have to take a view that I tell angels who want to invest in us 1 crore or 2, right? HNIs. I say basically you have to start thinking of us as minimum 3 crores over 3 funds, 1 crore each for the next 10 years. Otherwise, don't bother coming and giving me a check, right? We don't pitch HNIs anymore. We get a lot of inbound. And when they come inbound, I say this is the way to look at it. It's no different if you want to build an angel portfolio. It's just that you don't want a fund manager and you don't want passive. You want to play direct checks and play for the same outcomes. You like the idea that you get to see 100 plans and you want to put 10 lakhs into 10 plans. But you got to do that then. You got to put 10 lakhs into 10 plans over a 12-month, 18-month, 24-month, whatever your pace is. Do it 3 cycles and then sit back. Then if it doesn't work, retire from angel investing. That is the asset allocation problem. If you're actually going to do the work, then you better be sort of transformational in some tiny element, at least 5 things that you can do for the founder a year. Otherwise, you're just passive dumb money, right? They don't want you. And if you can do that, then you would essentially focus on either a sector or a geography, something that speaks to your strengths, as opposed to simply flailing your arms in every direction. And then build a reputation which allows others in that similar ecosystem to come and say, hey, let's start a fund together, right? Or let's do a, you have strengths in consumer brands, I have strengths in e-commerce, let's merge that into a aggregate consumer fund. And that's how I think a lot of these partnerships have materialized. There are 50 new funds in the last 5 years. So it's not, and there will be 100 in the next decade. So it's a good time to start thinking in that direction, but it's a very long-term commitment, right? And so you got to be clever about starting small and then just iterating as quickly as you can.
Right. I think the tagline for mutual funds is mutual fund sahi hai. We can change it for angel investing and say angel investing sahi hai with a question mark instead. Moving on to the audience questions, Manu, this one's for you. It's been upvoted thrice. So why did the question is, why did Manu name his fund as Sauce?
Look, I mean, we didn't want to take ourselves too seriously. Our clients are really our founders, and if you're really backing businesses which are creating brands, we wanted to have a sort of quirky and sort of easy to associate with, not seen as too overburdening or jacket and tie kind of investor. So we wanted to have a lighter, fun sort of play, but the more serious aspect to it, which is what I pitched to my LPs when I'm raising money, is that we're not just a provider of capital. We bring so many things that go into building a successful brand, and it's really like a great sauce, right? Lots of ingredients need to come together to create that exquisite flavor. That's what we do with our businesses. So that's the marketing pitch. But yeah, we just wanted to be not so serious about it. We want to have fun, and that's part of what sauce is.
Right. Awesome. The other questions by Pranay Sultania. He's a volunteer at Head Start Network Foundation. Karthik, why don't you take this one? Being institutional investors, could you highlight the three key things you look for while building your investment team?
Oh, that's a tough one. Each of our hires have taken like months, especially when you look at senior hires. We almost, and we have I'll disclose it, all of you can try and copy it. One of our tricks is to actually run them by our founders. Our founders interview our future employees. Anyone over associate level in the last 10 years has been interviewed by founders, right? So I think what we couldn't articulate to perfection is what constitutes Blume culture, right? And so we said that haziness is best articulated by why founders seemingly like us. So let them vote upvote or downvote this person. And people have passed the team test and failed the founder test, just to give you an idea of how seriously we take it, right? And so I think culture fit, which is not easy to determine. I've also started becoming more upfront about trying to find long-term orientation of why they choose to do this and how much money they hope to make. Because if I'm not able to fulfill that ambition, then they're just using me as a stepping stone. And I'm training the talent and then they walk through the door. And it's very difficult to have somebody allocate your capital, which you've hard earned, put it into a company and then walk out through the door, leaving you with the baby, right? And if it's okay if the person has become an adult, then there's not much child rearing to do. But if they're in kindergarten still, then you're screwed because you suddenly have 3 more babies to handle, right, in your portfolio. And so trying to evaluate these kind of, I'm not giving you perfect answers as much as it's the evaluation of these kind of culture codes that help you try to find the right person. Not like taking a playbook and saying MBA hai, if startup experience hai, and then just try to pile onto that formula. There are no formulas when you're hiring 5 people in a decade. Yeah. So, it's a lot of chemistry and it's a lot of sort of stickiness with the culture that you're trying to build. And sometimes better even you do.
I think there's a bit of a lag. I'm not sure Karthik will join us, but uh, Manu, next question. I mean, we can ask you this and then sort of take this up with Karthik. As an angel, have you been like arm twisted into doing a secondary you didn't want to do?
Even as a fund man. I mean, it's always a function of what kind of stake you hold, what kind of rights you have, what's the relationship with the founder, how much do you think the founder needs you in the subsequent stage of growth, how important is the incoming fund, how important is the capital raise from the incoming fund to sort of for eventual outcomes for all stakeholders, right? So there's no clear black or white answer on when you do get pushed into that position. But if the question is, do you get pushed into that kind of a situation? Yes, all the time, and that sort of comes with being the first check writer, right? It has its pros, it has its cons. Pros are you get in super early, you get the cheapest valuation. Cons are you may not get to prorate your participation as you go forward, but then it's the question of what you bring to the table, and do all stakeholders see your value in continuing. It's fine.
Right. I think a lot of this is dependent on the relationship that you, as an investor, have with your founder, right? So that becomes key. Cool. I think we'll wait for Karthik to join, but I'll ask you another question which Karthik sort of answered in his own way. What elements of being an angel do you truly miss?
I think it's so much less of a burden, right? What you're essentially doing is, as an angel investor, I'm hoping you're looking at a personal portfolio, taking out certain amount of risk capital, right? And trying to create long-term wealth from that. And you should look at angel investing as risk capital. It's something which can deliver you a 10x, but if you lose it all, you shouldn't feel bad about it. That's how I was. And when you do it like that, there's far less of a, you sleep easier. You've got much less of a burden of responsibility of managing third party money. Every time I
Right.
raise a rupee from an investor, it's an added responsibility. It's an added answerability that's on my shoulders, right? So angel investing is you're free to do as you feel. You can keep changing, pivoting, trying different sectors, trying your bets in different places. As a fund investor, you have a much defined path, a mandate, a stage restriction, a size restriction, and then the onus of responsibility towards LPs as well as founders, right? So
Right. No, 100%. I think we'll take one last question. This is from Kashyap Jayaram. At what stage do you recommend angels to exit?
look, I mean, it's really situational, and my friendly advice to all angels is, obviously build a view on the future of the company if you're involved and you have the ability to build the view. But at all stages, if you're able to take out your cost, right, at any point through a partial exit, please take it, right? And ride your profits thereafter for as long as you want to. But it's always a good idea. I have seen so many stories within angel investing and etc., where companies have gone like that, and for whatever reasons have then entry barriers or inability to scale etc. Have fallen off. So keep taking some chips off the table, and use your judgment and assessment. If you're getting a great exit, put greed aside, because you will get more opportunities to reinvest that capital. So do assessment of that and take your money out and get back into better deals.
Right. Karthik, would
Sorry,
love to have your perspective on
my
this.
network gave up. Yeah.
Karthik, good one. Yeah, you gave the Gyan for questions. I thought you cut out and left me to face that.
I'll cover up for the ones I missed. Yeah, go ahead, Jay.
No, so Karthik, just ask Manu this question. Would love to get your perspective on this. At what stage do you recommend angels to exit? And I know this is it's the worst thing is to overgeneralize here, but how would you tackle this question?
Yeah, it's a tough one. I think recycling capital. See, that's why I said it depends on what part of the journey you're enjoying, right? If you're simply going for the gains and you become passive and non-value additive, I don't think you can control that outcome too much, unfortunately, today. Because the founders don't want to keep diluting on behalf of passive capital sitting on the balance sheet. And they'll kick me out also someday if I don't add value. Right? That was the realization. So because it's a tough market, it's not like US where you have some legal rights, you're sitting in the corner, with common shares that you got, 10 rounds ago, and the paperwork is brisk and easy. They don't have to get your approvals and sign-offs. If you look at our documents, it's just a pain having more shareholders. It's as simple as that, right? So combination of that plus combination of the fact that you're passive and not adding any value after that, even sometimes before the first round, definitely after the first round, basically doesn't necessitate as much value in the heads of the founders. So they basically say, "Aapko exit mil raha hai, aap le lo. You've got a good outcome." And I don't have a strong, I've lived through it. So when people say, "No, you're now being the big bully VC," I'm saying, no, I've also taken those exits and walked out when I was an angel. right? And so it's just a cycle. And so if you think you're getting enough of a liquidity and it allows you to do the same from the proceeds, as an angel investor, that's half the joy. If you actually think you want to asset allocate and do this for a lifetime, then do it full time properly as a fund and add that value, right? You can't have it both ways. Is my humble take. So and otherwise, of course, in your best companies, you want to stick around as long as the VCs are, right? Why should the VCs are not dumb, right? If they're playing, then they clearly think there's an upside. So why are you getting out? But I think there's a natural course, is all I'm trying to say, right? Just as everybody exits in all the VCs, even the best of them exit at public markets. Why so? Because there's a cycle, there's a natural cycle. So I think for most angels, it should be, if things are doing well, you've stayed in the company for 4 or 5 years, you've got like a 3 to 5x. If it's a middling income, take the money and get out. If you think it's a rockstar income, it pays for all your mistakes over 5 years, then you try to hold as early as you can. But unfortunately,
Right.
I don't think you're in control of the situation as much as people think they are.
Right.
You can be a nuisance, but then you'll never be allowed into a cap table again. Yeah.
Yeah, I think being a low maintenance investor is also part of brand that you can have as an angel. So that's another point.
Yeah.
But thanks a lot, Karthik and Manu. You've been incredible. This was a wonderful session. I'm sure the audience enjoyed it as much as I did. Thank you so much.
Thank you so much.
Thank you.
Thanks,
Thanks,
Jay.
man.
Hope you guys found this useful.
Everyone
Everyone stay safe.
Yeah. And
Thanks a
be
lot.
Take care.
helpful to everyone you can. Bye.
Yes, awesome. Thanks so much.